Hello everyone, welcome to chapter 20. Chapter 20 is going to be about a topic that doesn't really get enough attention it deserves, but it absolutely is critical and important to your success as a trader, and that is journaling. In this video, we're going to discuss journaling in the most elaborate and comprehensive way possible, right? Now, I know that journaling might sound like something you can just skip, but trust me, it's one of the most important habits you can develop if you want to see real progress in your trading. It's not just about writing down your trades, it's about understanding your win rate, your risk reward ratio, and how those metrics actually connect to your overall performance as a trader. In this video, we're going to break down exactly why proper journaling matters, how you should approach it, and what specific elements to include in your journal. We'll talk about things like tracking the performance of your model, recording and tracking your own executions, and then we'll talk about the importance of performance reviews, how they're done, how you can do it yourself. And also at the end of the video, I'll also share examples of frameworks with you, both for journaling executions and trades and for performing performance reviews. By the end of this video, you'll have a solid understanding of how to set up a proper trading journal and use it to refine your approach and boost your performance. Now let's move on to the next slide and let's talk about journaling. Now, just like I said earlier, journaling is something that's absolutely essential if you want to improve your performance and sharpen your decision making process. So, what exactly is journaling? Well, it's all about systematically recording every aspect of your trades, right? That's what journaling is. That means documenting your entries, your exits, the market conditions that you took your entry, and most importantly, the thought processes behind each trade. How you are determining your drawn liquidity for your traded year, how you are building your narrative, and how did you actually frame your entry, right? You should be capturing and recording the thought process for all of your trades and make sure that you are documenting it properly. But it also doesn't stop there. It's not just about the technical. Journaling also includes documenting your emotions, your mindset, and how you felt throughout the trading day, right? Whether you are confident, you are nervous, or maybe even impulsive, right? It's important that you capture and document all of that. And by doing this, you're not only tracking your trades, but also your psychology and your emotional state inside those trades, right? Which can also be a predominant factor when it comes to executing trades effectively. When you journal consistently, it gives you the chance to go back, analyze your behavior over time, and then by that you'll start spotting patterns in both your wins and your losses, right? And this is where the magic happens, because once you understand what drives your performance, you'll be able to make better decisions moving forward and eliminate the bad habits or mistakes that you are making, which is acting as a hurdle between you and profits. So moving on to the next slide. Let's discuss and talk about the purpose of journaling and trading. Now, journaling is essential for developing a structured and disciplined approach, right? Journaling isn't merely a routine task, it's a vital component in developing a structured and a disciplined approach to your trading. It allows you to track not only the trades you make, but also your decision making process, your performance, and even your emotional state during those trades. This is crucial because it leads to much more objective trading, which is the key for achieving long-term success in trading. And without it, you won't be able to do it. Now, think of journaling as your personal tool for continuous improvement, right? It helps you understand how effective your model, your strategy, or your system is, right? And when you look back at your journaling entries, you can identify those recurring mistakes that might be slowing down your progress, right? Plus, it provides valuable insights on how to optimize your risk management, right? Reflecting on your past trades is fundamental for you to evolve as a trader, right? So it's important that you make journaling as a habit, as one of your habit as a trader. So, what you can expect from this video? We'll cover all of the key aspects of journaling, including how to track important metrics like your win rate, your risk to reward ratio, and you'll also learn how these metrics are interconnected and how they can impact your long-term profitability, right? Because we know that at the end of the day, it's not all about the numbers, right? You have to take care of both your technical side of trading, including your psychological side of trading, right? Because we know that our emotions can significantly influence our decision making process as well. So it's important for us to take care track both of them and make sure that both of them are thought through. And by the end of this video, you'll have a solid understanding of the techniques for creating an effective journal, and you'll know exactly what to record and how to leverage your journal for data driven improvements in your trading system. So, moving on, now that we've established the importance of journaling, let's talk about what to actually record in your trading journal, because this is exactly where the magic happens. First up is analysis. In the first part, we're going to discuss how we're going to record our analysis that we do and perform each day, and we'll see exactly what aspects and which aspects to include and to record to make it as effective as possible. Now, for recording and journaling analysis, you'd want to capture your high time frame thought process when determining your drawn liquidity, and you will record and note down stuff like what led you to identify those key levels, what time frames did you use, what concept did you use to reach that conclusion, and how that directional bias will affect your trading decisions on the lower time frame, right? Basically, every thought that led you to determining your drawn liquidity. And additionally, you'll have to document your thought process for how you built narrative both on higher time frame and lower time frame, and you'll write down what are the confluences, what factors were used, and how strong or weak that narrative is, right? And is that narrative aligned with the high time frame draw liquidity or not? And you would also rate that narrative based on a scale to 10. And then you'll also record how did you integrate those two aspects with each other, and how did you generated a trading idea because of it, right? And this integration is essential because it helps you understand how these different aspects were combined with each other and how different time frames influence your trading decisions. Those are the things that you're going to record in journal for your analysis. Next up we've got is the trade setup and executions. In this part, we'll discuss how exactly you will journal, record, or document your trade setups and your executions, both for your model and your own actual live executions. First of all, you will start off with recording and journaling the thought process behind how you position yourself in a CRT, how did you traded it, and how did you framed an entry, and what was the thought process behind it, right? That's the first thing you're going to document for your trade setup and execution. Then the next thing that you're going to record is the market condition. For example, the day of the week, what the date was, and then note down the kill zone or the time of the day that you took that trade, because these are important aspects and metrics that you must record for each trade consistently for your trading channel to be effective. Then the next metric that you're going to record is the CRT parameters, right? And what I mean by that is that you're going to record the timing of the CRT that you took, that you position yourself in. For example, whether it was a 9 p.m. CRT, whether it was a 1 a.m. CRT, 5 a.m. CRT, and so on. Now, the reason this is so important is because when you gather months and months of data, you will be able to see which CRT worked out perfectly for you and which CRT usually had a negative impact on your performance. And then based on that, those metrics and those factors, you can adjust and tweak your modeling system, right? But also you need to remember that you're not going to do that just based on a few experiences and based on few few trades, right? You're only going to do that when you have enough data collected, and you're not going to make these decisions based on just a few trades or a few experience, right? That's not how it works. Then the next thing that you're going to record and journal is the time that CRT that you framed an entry with was purged. You're going to note down the timing of the purge too, right? After that, we've got the risk parameters, right? This is important because with it you're going to see and assess whether the trades that you took, whether the risk per trade was constant or not, what was the result of those trades, what was the profit and loss ratio in relation to your risk to reward ratio, and you're going to record all of these metrics and parameters, right? And then you are also going to record the higher time frame aspects like the strength of your narrative, how well it backs your drawn liquidity, and so on. And this will help you evaluate the validity, the activity, and the overall quality of your trade, right? This is important because with it you're going to measure and assess whether the trades that you took or executed were valid or not, meaning the validity of the trades. You're going to measure the activity of that trade, meaning did you execute it or not, and based on all the previous factors you're going to calculate the quality of the trade as well, whether it was a good trade, a bad trade, or just an average moderate trade, right? You'll calculate and note down all of these aspects and these metrics. And finally, the most important one is that make sure that you're going to that you capture and calculate, not calculate, record your emotions during the trades as well, right? As well, how did you feel while entering the trade? Were you confident? Were you anxious? Or maybe you were overconfident? Because understanding your emotional state can be just as valuable as the trade metrics themselves, right? And by recording these elements, you will be able to perform effective performance reviews that will help you improve your overall performance as a trader. Now let's move on to the next slide. Right here in this slide, I will be showing you an example of how you can record all of these elements in a proper manner inside a journal. This right here is an example of a trading journal for recording trade setup and executions. Now for the analysis journal, you're going to take screenshots from the charts, and then you're going to explain your thought processes and bullet points in the form of notes, right? And you're going to save it somewhere in your computer or on Discord or Notion or whatever. This right here is a framework for a journal for recording or documenting trade setups and executions only. Now, before we discuss this table that we've got right here, let me give you some context. So for journaling, you can either use a digital journal software, right, which will automatically takes in all of your data and then shows you the important metrics like win rate, risk to reward ratio, and so on, right? Or the other alternative is to use either an Excel sheet like this, in which you will manually submit this data on your own, and then you'll also perform the performance reviews on your own as well and analyze it. No, for me, I personally prefer manual journaling where I submit and record these elements by my own and then perform the performance reviews by myself as well. Now, the reason behind that is simple, but we'll get back to this exact topic again later in this video. But for now, just remember that this is an example of a manual journal that I use myself on a Google Excel sheet, right? That's exactly the type of journal I use on a day-to-day and weekly basis. Now the data you see here is just theoretical data that I've put on randomly just to explain, just for the sake of explaining how recording these elements work and how you can do it yourself, right? So you can make your own Excel journal with a similar framework to this right here, and you can copy it from here. This is the exact type of journal that I use myself as well, and these are all the elements that I record and document. Now let's discuss each one of them separately. So the first thing that we're going to record is the day of the week. We're going to record the day on which we found that trade and then executed. This is important because during performance reviews, you can measure and analyze whether which days were profitable for you and which weren't. And then based on that data, you can then either try to avoid certain days or double down on other ones. And down below, you can see this theoretical data that I've inserted randomly for the purpose of explaining this to you. After that is done, we're gonna then record and document the date, including the month and the year as well. For example, November 12th or December 18th, etc. You're gonna record and journal the date of each of your trades here. After that, you're gonna record and journal the type of the trade. For example, whether it was a short trade or a long trade. It's just a simple metric to see which type of trade it was. Then the next metric that you're going to record is the result of that trade, right? Whether it was a winning trade or losing trade or a break-even trade. You're going to record this metric And down below you can see some hypothetical examples of winning and losing trades. After that, the next metric you'll calculate is the direction of the drawn liquidity of your trade. This is important because it let you know that whether the trade that you took had the high time frame drawn liquidity aligned with it or not. And then based off that metric, you can analyze and do performance reviews to see and check that whether most of your wins had the drawn liquidity, high time frame drawn liquidity aligned with it or not. And then you can do the same for losses as well. That will help you gauge and assess whether you should be trading in the direction of the high time frame drawn liquidity or not. uh, like simple, right? It's pretty obvious that you should only be trading in the direction of the high time frame drawn liquidity, but the problem is that most traders are also tempted to take trades in the opposite direction too, which also lead them to losses. And the only way to deal with that problem is by journaling those trades. And then at the end, when you perform these performance reviews, you will see that most of your losses were because the trades weren't aligned with the high time frame drawn liquidity. And then that way, based on that data, you'll realize that trading against the high time frame drawn liquidity is never a good idea, and you should always stick to the high time frame drawn liquidity. And you would believe in it because it's proven by the data that you've yourself collected, so you'd be more confident in that data in that performance review, and you'll deal with that problem more effectively because you collected that data yourself, right? Similarly, what you will also see is that most of the wins that you had were all aligned with the direction of the higher time frame drawn liquidity, and that way you'll stop taking trade against the drawn liquidity. Moving on, the next metric that you're going to record is the strength of the narrative. Now you know that what narrative is and how it works, right? Basically, we use concepts like the open, high, low, close concepts, market profiles, and advanced intraday and weekly profiles to measure and assess whether how price or in what fashion price will go towards the drawn liquidity. Now, the more confluences you have backing up your idea, the stronger the narrative is, right? For example, if you've got conferences like the open, high, low, close concept, the power of three, intraday profile, weekly profile, as well as SMT divergences, right, behind your trade idea, then you'd classify that narrative as a strong one, and you're going to record it for that particular trade in your journal like this. But if the narrative doesn't have that many confluences behind it, or you've just built it based on just one or two confluences or concepts, then you would classify that narrative as a weak one or a moderate one, right? And again, if the narrative doesn't have any confluences at all, or maybe just one confluence, then the narrative isn't a strong one. Then in that case, you'd classify it as a weak narrative, right? Now, the main reason behind recording and documenting the strength of the narrative behind your trades is that it would again let you know whether your wins and losses had a strong narrative or weak narrative behind it, and that way you'd be more conscious and cautious of your trades ideas next time. If you found out that most of the losses that you incurred had weak narratives behind it, then next time you'll make sure that if a trade doesn't have a strong narrative behind it, then you would avoid taking it, right? It would also let you know how you are performing in the sense that the trades that you are executing are well thought or not. For example, if you see that you often take trades that have weak narrative behind it, then that means you're not taking the process seriously, and you should re-evaluate your trading ideas in your decision making process to make it more effective by making sure you only take trades that have a proper strong narrative behind it. Now, it doesn't mean that if your drawn liquidity is aligned and if your narrative is strong, you wouldn't take losses, right? No, you'll still have loss and you'll still incur losses even with that framework. But the thing is that way you'll be more protected and your win rate will be a lot higher because you're only taking high probability trades, right? And that's exactly how you classify a trade into a lower probability or high probability uh, classification, right? If it has a strong narrative behind it and the drawn liquidity is perfectly aligned, then that's a high probability trade. But if those metrics aren't aligned, then that's a lower probability trade that you shouldn't be executing in the first place. And recording these metrics will make sure that you're always under strict monitoring and then you could see at the end of each week and at of each month your past trades, and you can see that whether those were quality trades or high probability trades or not, right? Moving on, the next two metrics that you're going to calculate is the timing of the CRT that you selected, as well as the timing that CRT was purged, right? These are important metrics as well, because with it, not only you can identify the key times of purges and the key times for CRT formations, but also along with that you can keep track of what sort of CRT are you choosing, whether you are trading CRT that are formed at key times or not. And similarly the same could be said for the timing of the purchase as well. And next up is the validity of the trade. With this, you're going to see whether the trade that you took was valid according to the criteria and parameters of your model or not, or whether this trade was outside your model but you took it because your emotions got a good hold of you, right? This is the validity metric that you're going to record. And next up, you're going to record in general the activity of your trade, right? Activity basically means whether you execute it or not, or whether you are just watching it play out, right? What this is going to help you with it is that it's going to show you whether you perfectly executed all your trades that your model offered, or whether you are a bit inconsistent in your approach, right? It would monitor your performance in that aspect. Next up is the quality of the trade. You'd have specific protocols and criteria for your trades based on which you can classify each trade as a good trade or a bad trade or an average trade. And you can consider aspects like drawn liquidity. If the drawn liquidity, for example, is aligned, then that's a good trade. If it's not aligned, then that's a bad trade. You'd also consider criteria and protocols such as the strength of your narrative, the presence of a key level or not, whether the trade was taken at a key time or not. And based on all these metrics, you're going to classify your trade to a good one, a bad one, or an average one, right? And then you'd record and document that in your trading journal. Also, if for example, if it's a trade that your model never offered but you took because of something else, then that's also a bad quality trade that you shouldn't have taken. Now, remember that the quality of the trade doesn't have to do anything with the result of the trade, right? Remember that you'd never classify your trades after the fact, right? But instead, you're going to classify it into bad or good quality before the trade plays out, right? And you will only look at factors like whether the trade was valid or not, whether the drawn liquidity was aligned or not, whether the narrative was strong or not. These are the factors that you will consider, right? You won't consider the result of the trade. For example, if a trade is valid, the drawn liquidity is aligned and the narrative is strong, but it turns out to be a losing trade, then it still is a good trade because it had all the good qualities behind it. And similarly, a trade can turn out to be a winning trade, but if it's not valid and it doesn't have the drawn liquidity aligned and the narrative is weak, then you would still classify it into a bad quality trade even though it was a winner, because if you keep taking these trades like this, it would reinforce bad habits in you, which you would want to avoid at all costs, right? At all cost. So simply the quality of the trade doesn't have to do anything with the result of the trade. It only has to do with the analysis factors and the metrics of the trade, right? So remember that. Now, the point of recording this is to make sure that you're first of all aware of the qualities of the trade that you are taking, and second, so that over time you're only making sure that you are taking good quality trades and not bad quality ones, and that way it will reinforce good habits in you and it will eliminate the bad habits. That's the quality of the trade metric. Last but not least, you're going to calculate the profit and loss ratio of that trade in risk to reward ratio, or RR. For example, if the trade was a loss, then it's a -1 R. If it's a win, if it's a 2 R win, then it's a +2 R win, right? And so on. Here you're going to make sure that your risk management is the same for all trades and your risk per trade is constant throughout. Otherwise, it will mess up with your performance in these metrics. And then at the end, you will write down a few notes and bullet points regarding your psychological state and emotional state when you were executing the trades, or any notes regarding why was the quality bad and why did you execute an invalid trade, or why did you miss a winning trade, or so on, right? You'll note down all of these notes and bullet points. And that way, at the end of each week or month, you can look back at these notes and see whether there are any recurring problems that you have that is holding you back from taking good trades, or it's making you miss good quality trades, and so on, right? This journal may show that you're recording every single important aspect, and then you can perfectly perform performance reviews on them, which will show you your performance, and then you can review them and make adjustments to them that will improve your performance as a whole, as a trader, right? You'll be reviewing all of these metrics later and analyzing their performance. All right, now let's move on to the next slide and let's discuss the second half of journaling, which is actually the most important part of journaling, which is performance reviews. Now, this is where all the effort you put into your journaling starts to pay off, right? Because you know that journaling isn't there just to record or document your trades, right? Doing that alone does not serve any purpose. It only starts to make sense when you do these performance reviews and actually review and analyze your trades and all the metrics that you had collected. And then based off of those analysis and those data, you start to improve your system as a whole and yourself as a trader, right? Only then you see that journaling is actually worth it. Now, what you should do is you should make it a habit to set aside dedicated time for this, whether it's on a weekly or monthly basis. And then during these reviews, you'll be going through your past trades in detail, right? Now, the idea here is not to just analyze the outcome of your trades, but also the processes behind them, right? You're going to start by reviewing both your winning and losing trades, right? And you're not just going to focus on the result, but you're going to actually dig deeper into what actually happened, right? You're going to look at metrics like the validity of the trade, the quality of the trades, the drawn liquidity and narrative behind it, and all the different metrics that you had collected, right? You're going to look for patterns in your trades. Were there any common market conditions or emotional triggers that led you to losses? For example, you're going to see that did you find yourself losing more often during certain sessions like London or New York kill zone, or maybe you lost more under specific market conditions? Did your losses had a certain theme to it in terms of drawn liquidity and backing of narrative? And did you executed quality trades or not? What were the conditions of your emotional state inside those trades? And how did you behave and conducted yourself in those scenarios? And so on, right? You're going to analyze all of these metrics and factors leading you into the trade. On the other hand, you are also going to examine your winning trades as well. What was working in your favor? Were these trades executed exactly as per your plan, or did they work out because they had drawn liquidity aligned in strong narrative? Were they aligned with your model or not? Were you more focused and disciplined in these moments? You're going to analyze all of these metrics, right? And then you're gonna identify all of those factors which led you to a better performance. And the reason this is important is because it's essential to refine your model and your personal approach, right? Because that way you'd want to reinforce those behaviors that led you to those winning trades, right? And then after that, you're going to take a closer look to how well you've been sticking to your plans. You're going to compare the plan setups of your model, which your model actually offered, with your actual executions, meaning your the trades that you actually took throughout the week or throughout the month, right? And you're going to see that you followed your predefined risk parameters and trade setups, or did you deviate because of external factors like market noise or personal emotions, right? This is a big one because even the best trading model can fail if you're not disciplined enough in your execution, right? If you are noticing repeated deviations, then that's a sign that either your strategy might need adjustment or you need to work on managing your psychology better. And lastly, you're going to realize and you're going to admit that these performance reviews and these processes are all about continuous learning, right? You're going to use the data in your journal to identify what's working and what's not, right? It's all about making those small and those important improvements. And if you consistently spot the same mistake, you're going to realize that now is the time to correct them before they become bad habits. And on the flip side, if you see certain elements of your strategy working consistently, then you're going to double down on those. And over time, this regular review process will help you become more disciplined. It will refine your edge, and most importantly, it will improve your long-term profitability. Right? So in journaling, the second part or the second half of journaling, which is performing these performance review, is the most important part, right? So make sure you do not overlook this step, right? Because it's not just about entering trades or documenting them. It's about analyzing and learning from every trade that you take, and then that's exactly how you're going to go as a how you're going to grow as a trader, right? And that's how you're going to make sure and ensure that your trading system evolves with you. Moving on. Now, one of the most valuable aspects of journaling is that it allows you to identify patterns or reoccurring themes that shows up in your trades, right? Both the good ones and the bad ones. Now, this is one of those things that can truly transform your trading because it gives you insights into those areas where you might not notice in the heat of the moment while you are trading, right? Now, let's say you are going over your journal and start to notice that your performance tends to improve during specific market conditions. Maybe you consistently do well during certain CRT formations times or certain CRT which are purged specific times, but struggle with other CRT times and so on, right? Or maybe you find that certain times of the day, like the London or New Year session, bring you better results, right? And then these are the types of patterns you want to pick up, right? Pick up on, because they give you a clear indication of where your actual strengths and weaknesses lie. On the other hand, journaling also reveal patterns related to your psychological state as well. Maybe you've noticed that your decision making process gets worse after a losing streak, or that you tend to exit trades too early when you're feeling overconfident. And then recognizing these psychological triggers is just as important as understanding the technical side of your trading. Another major thing to look out for are common mistakes, right? Do you find yourself consistently entering trades with a weak narrative behind it? Or maybe you are realizing that your trades aren't properly aligned with the higher time frame directional buys or drawn liquidity. And then these are the mistakes that, when repeated consistently, can lead to bigger issues down the line, right? Now, the beauty of journaling is that it highlights these aspects so you can take corrective action. If you are repeatedly making the same error, then it's time to reassess your strategy and or improve your discipline. And when you start to recognize the positive patterns, you'll know exactly what to focus on and what to replicate in your future and the future trades. So in short, journaling is basically like holding a mirror up to your trading habits, right? The patterns that emerge can either be opportunities for growth or red flags that need attention. And by identifying these patterns, you set yourself to make smarter and much more informed trading decisions moving forward. Now let's move on to the next slide and let's discuss an even more important tool used in performance reviews, the execution consistency ratio or ECR. Now this is a tool that measure how closely you're sticking to your trading system or model, right? In simple terms, it compares the ideal setups and entries of your system based on the rules and parameters that you've laid out with the actual trades that you're executing on a day-to-day basis, right? So why does ECR matter? Well, it helps you gauge whether you are following your trading plan consistently or not. A high ECR means you're executing trades exactly as your model intended, right? According to your model. But here's the catch. If your ECR is high and you're still not getting the results you expect, then it's a sign that your trading model might need some improvement. Maybe the narrative that you build isn't holding up under current market conditions, or maybe your risk management approach needs adjustment, right? On the other hand, if you've got a low ECR, it means that you're frequently deviating from your plan, whether that's missing entries, skipping setups, or taking losses that weren't valid based on your system, right? And that's something you want to address immediately because it shows a lack of discipline. You could have the best trading model in the world, but if you're not executing it properly and consistently with discipline, then you won't see the result that you're after, right? A high ECR with positive result is what we are aiming for. It tells you that both your model and your discipline are on point. But if your ECR is high and your results are still negative, then it's time to reevaluate your model because you are consistently following your model, but it's the model that's actually causing you issues, right? Issues. Now, this ratio really helps you reflect on your performance and gives you a clear picture of where the issues lies, whether it lies in the execution or in the model itself, right? Now, the idea behind ECR is simple, right? By comparing your ideal trade setups with that you actually executed, it shows you exactly where things went off track, right? Whether it's missing a good setup, skipping a valid trade, or taking an invalid one. ECR highlights all of these discrepancies in your performance. Now, these gaps between your plan and your actual trade gives you a clear insights to where you are struggling, right? Where emotions, overconfidence, or even fear may have start to impact your decision, may have started to impact your decisions, right? Or maybe you hesitated and missed a trade, or you jumped into a one without fully thinking it through. And the only way you're going to spot and highlight these issues and these mistakes is by using ECR, right? ECR helps you catch all of these mistakes and all of these performances of yours. Now, the beauty of tracking your ECR over time is that it lets you pinpoint inconsistencies in your execution, right? And once you see those patterns, you can focus on refining your discipline, right? It's like a mirror reflecting both your good habits and bad habits, right? ECR is also an amazing tool for accountability. When you are regularly reviewing your consistency, you're making sure that you're sticking to your plan, uh, and as your ECR improves, that means your dating discipline is also improving, which can lead to better long-term results and less emotional decision making. And the more you refine it, the more objective and disciplined you become as a trader, and that's where the real progress starts to happen. Now let's move on to the next slide and let's discuss how to actually do these performance reviews on a weekly basis. Now, first thing first that you must remember is that this right here is just only 20% of the actual performance reviews that I do on a weekly and monthly basis, right? I do 4 performance reviews on each monthly basis. Two of those reviews are concerned with the technical side of my trading, and two of them analyze and check the psychological side of my trading. Now, one of those technical performance review is concerned with the technical analysis side of trading, like dawn liquidity, narrative, key level CRT, and so on. And the other one is concerned with the technical metrics of my trades, which is this one right here in front of you. Now, I've came up with these performance review techniques on my own research and experiences, and I've refined it to my own personal approach, right? I didn't learn it from anyone. I just gather resources from different sources and I gather them all to this one system for myself, right? Now, I'm not going to straight away share all of them with you because they are really close to me and my success as a trader. I might share those framework with just a few students that are close to me, but not to the whole public for now. But I'll definitely share one of those frameworks, one of those performance review frameworks here, which I perform weekly, which is this right here in front of you. So this performance review table that you see is concerned mostly with the technical metric side of trading. On the left, you can see the red tab, and this tab basically shows the trades that your model offered throughout the week. Now remember, these are not your executions, right? These are just the trades that your model offered based on your set rules and criterias and parameters for trades, right? Each week you're going to go through charts and record all the trades that your model offer. Whether you took them or not does not matter. Now the reason you're recording these trades is because with the help of it you're analyzing the performance of your model, and not you but your model, right? And the important part about this is that this shows your model performance without your interaction with it. Now, the main problem that people face and the biggest mistake that people make is that they try to evaluate the performance of their model based on their own executions, which is absolutely wrong. Because if you are evaluating and reviewing your model's performance based on your executions, then you are missing the whole picture because you are including your own discrepancies and mistakes in it too, which isn't part of your model at all. And due to that, you start mistakenly concluding that your model is weak or that it has a lower win rate and risk reward ratio. But instead, the actual reality is that you mistakenly reviewed your own execution and performance and then mistakenly attached it with your model's performance when in reality it had nothing to do with it. And then because of that mistake you change your model even though it was good in the first place, but the problem was with your own execution, right? So that's why you're going to record the metrics of the trades that your model offered separately in this red tab right here, right? So that you can see how did your model offer without you interacting with it or without your own discrepancies in your executions. On the other hand, on the right side, you can see the green tab. And in this tab right here, you'll be recording and documenting your own executions, meaning the trades that you actually took throughout the week. And you're going to put the metrics like win rate, risk to ratio, and so on. Now, remember the journaling format that I showed you earlier. You're going to bring in data from that journal to this performance review framework right here, right? You're going to use exactly that journal and bring data from that and analyze them and then put it here. For example, in that journal, we had first of all the first week, and from that journal, you can see that our model offered 5 trades. Now, if you ask how 5 trades, then if you look at that journal I showed you earlier, then there you would see that out of all the trades from the first week, 5 of them were valid trades, and by valid I mean that it were trades that the model actually offered based on the parameters from the model. So that means the model actually offered 5 trades. Now you took those trades or not does not matter. What actually matter here is that your model offered and you'll record it in here. Now out of those 5 trades, 3 were wins and 2 were losses. So that means your model had a 60% win rate that particular week. Now remember, these are just hypothetical random data, right? I've put them on here to just for the sake of explaining these to you. And you're gonna copy this exact framework from here, and you're gonna put your own data here as per your journaling data that you would have collected throughout the week. And then you can see that the first week your risk reward ratio from your model was a constant of 3R, and your model ended the week with 7R profits, right? That's how your model performed this particular week. And then your next job is to record and document and analyze your own execution throughout this particular week and see what was your performance. And you're going to bring that data from the journal that I showed you earlier. And you're going to record the data which you actually took, meaning all the trades that had the activity metric as taken or yes, right? And after bringing that data from there right here, you can see that this particular week you also executed 5 trades, but 2 of them were wins and 3 were losses. And you can see that there is a clear discrepancy there, and your win rate turned out to be 40%, right? Now the discrepancy was arise due to the fact that you took an invalid trade which turned out to be a loss, right? Meaning you took an invalid losing trade which your model never offered, and along with that you also missed executing a winning trade that your model offered but you never took, right? And due to those reasons you can see that there is a clear discrepancy in your execution and how your model performed, and because of that you ended up the week with 3R profits. Now, these 3R profits is still good for a weekly performance, but that's not the point. The point is that you did not stay disciplined and you weren't fully consistent throughout the week, and you took an invalid loss, meaning a loss your model never offered, and you also missed a valid winning trade by not executing it. Now you would know the reasons behind these mistakes, and you would have written down the notes in the first initial journaling section, and you would know exactly why did that happen, and then with those you would perform in another psychological performance review. But that's a topic for another time, right? So on the left you've got your model performance, and on the right in the green, yeah, your own performance, meaning the trades that you actually executed on your own. And in the middle you can see the ECR section where you'll calculate your ECR based on this data you can see right here, and it will give you an ECR percentage value. Now to learn more about ECR, you can watch the weekly performance review chapter I made, and that will clear your confusions. So after calculating ECR for the first week based on this data that we've got, you can see that the ECR was 60%, which is considered a low ECR. And that means that you weren't holding up to the standards of consistency, and you were pretty inconsistent in your approach and your executions. Similarly, you can see the data from the second week too from the journaling tab, and you can see the data by yourself and see the discrepancy again and why did those discrepancies occur. Now to improve this ECR, you would already know the reason behind your mistakes, and then your job would be to perform psychological performance review and note down all the recurring theme and patterns among those losses, and you will see what issues you got or what were the catalysts that led to those problems, and then you will try to find coping mechanism for it to effectively deal with it. And this is exactly how you will improve your performance as a trader. Now, I know that no one talks about this stuff, right? No one really discusses it, but this is what actual real trading is, right? Most of the stuff and most of the work is done behind the scenes here, right? And that's why you can see that I have the executions that I have. It's not because I have the perfect system, but because I have refined my system to a point that it suits my style the best, and it has no flaws at all. It has losses and they're inevitable, and I admit that, but it doesn't have any flaws in the sense that I consistently follow it without any ineffectiveness or inconsistency in my approach. Now let's move on to the next slide and let's talk about the psychological aspects of trading, right? Which we all know are just as important as the technical side, if not more. When it comes to emotional control, emotions like fear, greed, or even overconfidence can really mess up with our decision making process, right? And by consistently journaling our emotional state before, during, and after each trade, you start to see how much emotions actually influence your trades. And over time you will begin to spot patterns like maybe fear of missing out causes you to take impulsive trades, or overconfidence after a winning streak leads you to poor decisions. And these emotional triggers are key to understand because they can consistently lead to losses if not managed properly. And then there's the mindset review. It's not enough just to track your emotion, right? You also got to look at your overall mental state during trading. Were you calm and collected? Were you stressed, anxious, or maybe even distracted, right? What was your mindset when the market was in different market conditions? And documenting this helps you figure out the mental states that lead you to best decisions and those that set you up for failure. And over time, by analyzing both your emotional control and mindset, you'll get a clear picture of when you are in the right mental space to execute trades effectively. And recognizing these moments can help you avoid making poor decisions when you are not in the right headspace, right? And that will lead you to a more consistent and disciplined trading approach for you. Now let's move on to the next slide, and let's discuss and go over some final tips for successful journaling. First and foremost, the first thing is that be honest and detailed, right? Journaling, first and foremost, be honest and detailed, right? Journaling is only going to help you if you're completely upfront with yourself, right? Don't gloss over your mistakes, don't ignore your fears, and definitely don't leave out your biases. These details, even the comfortable ones, are exactly what you need to spot patterns and then to eventually improve, right? And next is that stay consistent, like just like with any other skill, journaling works best when it becomes a habit, right? It's easy to journal when things are going well, but the real growth comes when you stay disciplined, right? Even during the tough times. after losses or frustrating trades, right? It's all about those long-term insights, and they only come if you stick with it. And finally, use journaling to encourage self-discipline and accountability, right? Journaling forces you to confront your own decisions, to analyze where you went wrong, and to keep yourself accountable for sticking to your trading plan. And last but not least, start today and take action right from now on.